What's going on, y'all? Welcome to another edition of Weeds Weekly, where I, Kevin, take you down the path of what happened this past week as it pertains to mortgages and real estate. We're going to talk about this coming week, what's on the radar as far as data. We're going to get into waiting could have a cost. So I want to talk about that because a lot of clients these days, for all of us in this space, are talking about waiting, whether it be refinancing or purchasing. And then it's a supply problem, y'all. So that's exactly what we're gonna talk about. So let's just dive into what happened last week. And the main thing that came out last week is inflation continues its slow drip, right? Inflation's been the underlying problem of the Fed since the beginning of 2024. They thought they had it under control. It became sticky, it became persistent, and now it's gone back to sticky. But the main thing that we're really learning is probably for about the last 4 months, inflation is coming down. It got below 3% for the first time since like March of 2021. But make no mistake about it, it is something that is still very concerning to a lot of American families. When you go to the grocery store, it is very apparent the cost of products. And then if you do anything like I do as far as building, the cost of services, having somebody to come into your home, the labor market, it is expensive, but it's moving in the right direction. So as far as the Fed is concerned, their plan is working, right? The soft landing, inflation seems to be moving in that right direction. So the nice thing is we can expect that September rate cut that we've been talking about week after week now. The other thing that we saw is jobs and retail sales suggest otherwise. So last week, I think I highlighted a little bit about what I thought might be down the path of a potential recession. Well, retail sales came out higher than expected, as well as initial jobless claims came in better than expected. So the bigger concern, right, the main thing that changed focus was the Fed went from having an inflationary focus to talking more about jobs, the labor market. That's something that could spiral us if it changed quickly, and we saw that non-farm payroll numbers change very quickly, could push us into a recession. But these initial jobless claims numbers are coming in better than expected. They're actually coming in lower than forecast, which is leading traders to believe that maybe the labor market is not under as much stress as it was. That is going to be determined next month. I think we're going to see a lot of steady, slow and steady pace here as far as interest rates. We're going to hover between that 3.8 and 4% as far as the ceiling and as far as the floor. That's what I predict. And you're going to see very little movement in interest rates until we get that non-farm payroll number at the beginning of September, before the Fed meets on September 12th. And the nice thing that I think that we're going to see this week is there's not much economic data, but as we have fallen asleep before previously at the wheel, I made that promise and I wouldn't again. So we're going to, just talk really briefly about this coming week. It is a very extremely slow week, but there can always be peaks and valleys in those, right? There could be something that the Fed says. And the big thing that we have on docket this week is you have Fed Chairman Powell is going to speak on Friday. You also have other Fed members speaking throughout the week. And what traders and investors are going to be looking for is any language that changes that gives them a better indication of what are the intentions of what the Fed is going to do for September. Are we going to get a quarter point? Are we going to get a half a point? And then what does the rest of this year look like? Do we get more cuts in November? More cuts in December? I think what you're going to hear is a lot of the same rhetoric we've been hearing, that they're going to remain data dependent like they should. They're not going to jump the gun on anything that they perceive could potentially move the markets. They're going to be slow, they're going to be steady, they're going to be consistent, and I think that message is going to remain the same. And I think, like I said already, that non-farm payroll number that comes out next month is going to be the determining factor of what the Fed does in September. Do they give us a half a point or do they give us a quarter? Right now it's a coin flip, and I'm erring on the side of a quarter. I don't think the Fed wants to do anything too drastic. They want to allow this soft landing to occur, but they want to encourage the market a little bit and give them that quarter point. So that's what I am predicting. And the Fed's new focus, as I already mentioned, is jobs. Jobs is the biggest thing. And the funny thing is, jobs comes out every week. Initial jobless claims comes out every week. And then we have to wait through Labor Day weekend for that first Friday. So we're at least a couple weeks out, 2.5 weeks out, till we get that new non-farm payroll number as well as the unemployment number. And that will be something that has the potential to really move the market. So we want to keep a close eye out on that. We'll have some more inflation numbers in the meantime, but this week is a really, really, really quiet week, but we stay focused. So those are the main things that I think we want to pay attention to this week is Fed Chairman Powell speaking. We also want to look at, let's see what else is coming in this week that I think may have the potential. You got manufacturing PMI, services PMI, so you're going to look at what forecasts are looking at on the manufacturing sector and the servicing sector. And the other thing is we're going to get a read on how much the real estate industry is struggling on a national level. Remember, real estate is very hyper local focused, so it's going to be very different. I'm sitting up here now in Michigan. It's a tight market, but it's a tight market because of limited supply. Where down in Austin, where I live, it's the entire opposite. Huge supply, and we have a market that's going through a correction. Prices are going up here, two totally drastically different markets, but we're going to get existing home sales and we're going to get new home sales this week. So let's dive in as well. I talked about it last week and I got a lot of clients that are on the waiting game. I talked to a lot of agents this past week, called them up, had some conversations, and it's a lot of buyers are waiting. They think prices are going to drop even further and so on and so forth. So what I wanted to do is kind of put some numbers to that, right? So let's assume that you buy a house, you get a rate of 6.5%, and you're waiting for interest rates to drop. You're like, okay, I could buy it today. My loan amount could be $400,000, but I think that rates are going to drop. What's going to happen is, the crazy part is once rates start to drop, you're going to see increased demand, especially in a market like Austin, Texas. And this is why I'm always stressing that right now is kind of the perfect storm. You got sellers that are willing to negotiate, as well as you have prices where they have come down a little bit and you have a ton of supply. So you have houses that you potentially could have not seen previously. Now they're accessible to you. I think it's the perfect storm to purchase. But in looking at that, what's going to happen is once interest rates start to drop and we get through this election, what's going to happen is it's going to increase demand, which is going to cause prices to go up. It is. It's basic economics. And when that happens, what you can see is, and what the numbers lay out is, if you have a 5% increase in the loan amount you are going to get, you're going to have to see a 0.5 point decrease in interest rate just to be at the same level, essentially. You might save $10, $20, $30 a month, but it's no big break. Whereas if you go buy the house today, the house that you want, you secure the lower loan amount and then you get the rate increase. That's where you're going to see the big benefit. So that's why I'm just talking and I'm trying to put numbers to this, and you can look at it in the graph. And if you need those, or you're listening to this video and you don't see the graph, just reach out, DM me. I'm more than happy to send it to you. But this is where the numbers are not lying, and what they're showing is, look, you're going to need to see drastic decreases in interest rates up to a 0.5 point. And if you see a 5% or 10% increase in the loan amount that you have to get get that house because of increased demand once it happens, and you also have people speaking of new home buyer incentives of $25,000, that demand side is going to increase the home values, which means your loan amount increases, which means waiting is going to cost you money in the long run. So I break that down. I think that's a great topic. And it's in a way for us to get clients that are sitting on the fence off. Look, numbers don't lie. 2 + 2 = 4. So if I can be of any further help in that way, please do not hesitate. And if you're a client that's looking and just want to have the basic conversation, I'd love to have it. I love talking numbers. They don't lie. And I love to crank any numbers that you feel would be necessary to help you make a great decision. But right now, I think it's the perfect storm. And then the last topic I wanted to touch on is it's a supply problem. What's interesting is, for whatever reason, the real estate industry seems to now have a target on its back. And the target is due to the government. The government, for whatever reason, believes that the real estate industry right now is prime for the pickings, and we have a target on our back. Whether it's NAR that just got introduced this past week, and it basically was implemented, and you have both consumers and you have also professionals in the industry or that are just uncertain of what it means. But you have two proposals that have basically been introduced, one being rate caps on landlords, and the other one that was just most recently introduced, I want to say it was Thursday of last week, was the $25,000 first-time home buyer program. And I'm here to tell you, first and foremost, You do not throw money at the demand side when the demand side is not a problem. It is basic economics, right? We have a supply problem in the real estate industry, and more importantly, an affordable supply problem. You don't throw money at the demand side, because what it's going to do, it's going to do these 5 things. First and foremost, increased demand is going to push prices up, and more specifically, it's going to push home values up in the exact category that the people that you're trying to help, the first-time home buyer, those prices are going to increase. Number 2, it's basic economics. If you increase demand, you're going to have limited supply. You're going to push those values higher that I just talked about, right? The homes are going to become less affordable. It's going to do the exact opposite effect. The third thing is free money. Sellers are going to want a piece of this. If you're going to give buyers $25,000, what do you think sellers are going to do? They're going to increase the values of their home. Even all the way up the line, I'm going to increase the value of my home. If that $300,000 home is now worth $325,000, well, then my $700,000 home is worth $750,000. Again, it's such a horrible idea. I can't even express it. Like, it's almost as if politicians, all the people that are trying to dictate instead of letting capitalism flow through, they're trying to tell us how to fix a problem that doesn't need to be fixed. There's not a demand side issue. It's maddening. The fourth thing that I see is it's going to create inflation. When you get government throwing money into a system, right? So you're just getting dollars chasing fewer goods, it creates inflation. And what it's going to do, it's going to create shelter inflation. Huge concern, right? I can't express how bad I think this is for the overall economy, and it's going to create more affordability issues. You're giving people $25,000 as a first-time home buyer for actually so they can get into the home, but it doesn't create any relief as it pertains to affordability. So now if you have a higher home value, that means that their payment's going to go up. It means that they're going to have higher insurance. They're going to have higher taxes. You're not helping them with the monthly affordability issue that is just staring us in the face on a global level, on a national level, on a nationwide level. That is the problem. That's what needs to be addressed, right? And I know that they work on that side too, but don't waste the money throwing it at the demand side. Focus on the supply side. All right, everybody, have a great week. I hope you're out there, you're kicking tires, you got a lot of activity, you have any questions, you need a flyer, you need numbers done, you need me to crunch numbers for a potential client that you have. I would love to help. I'm working even though I'm traveling. I'm a phone call, email, or text away. So happy selling out there. Enjoy your week. I'll be coming at you on Friday with that wrap up. So as we head into the weekend, you have great discussion points of what happened this week, even though it's light on the data side. All right, y'all. Have a blessed week. Cheers.